Imagine winning at the stock market using the same strategies that turned a struggling baseball team into champions. Sounds impossible? Think again. Welcome to the world of Moneyball investing. Today we're looking at an interesting connection between baseball and investing, inspired by Michael Lewis's book Moneyball. The way the Oakland A's played baseball can actually teach you how to make more money through smart investing.
Direction of the Oakland A's. We are card counters at the blackjack table. We're going to turn the odds on the casino.
Michael Lewis is really good at turning boring financial topics into exciting stories. In books like Liar's Poker, about the savings and loan crisis, The Big Short, about the GFC, and Flash Boys, about algorithmic trading, he makes complex subjects interesting. Today we're focusing on Moneyball and what it can teach us about investing. Lewis was interested in the Oakland A's because they were doing better than richer teams, even though they had less money. He found out that the market for baseball players, like financial markets, isn't always fair or efficient. While doing his research for the book, Lewis discovered that Oakland A's team managers were looking for players that other teams didn't think were very good. These players didn't look like typical professional athletes, but the A's saw their hidden value. This is similar to some investment strategies that people overlook, because they don't look good at first. In both investing and baseball, looks can be deceiving. We often like investment strategies that look safe and give steady returns, but they aren't always best in the long run. The Oakland A's succeeded by choosing players who are undervalued because other teams judged them based on looks and not their true potential.
May not look like a winning team, but you are one. So, play like one tonight.
Similarly, some of the most effective investment strategies may appear unattractive because of their volatility or lumpy return profiles. Here I show one good strategy and two average ones. When combined with equal weighting and the same volatility of the orange system, we get the blue line. Magic. And see how they all reacted differently in the COVID crash, where the circle is. It works because we are picking different players based on the value they add to the portfolio overall, by how they combine. Let's make a connection here. Think about the great psychologist Daniel Kahneman, who studied how people make decisions when they're unsure. His work with Amos Tversky showed why experts, whether in baseball or finance, often get the true value of things wrong. Our minds make systematic mistakes when dealing with uncertain situations, leading to bad judgments. The Oakland A's took advantage of these mistakes by realizing that good-looking players were often overvalued, while less impressive-looking players were undervalued. The same idea works for investing.
You don't put a team together with a computer, Billy.
Adapt to die.
Strategies that might seem unattractive because of their ups and downs or unusual methods can sometimes be very valuable. Now let's dive deeper into how this applies to our investment portfolios. Traditional investment wisdom often emphasizes low volatility and consistent returns. These characteristics are attractive because they align with our desire for stability and predictability. However, such strategies can sometimes lead us to miss out on opportunities with higher potential returns, simply because they seem riskier. Think about trend-following strategies as an example. These strategies can look volatile and unpredictable, with many small losses which make many investors avoid these strategies. But if we examine the long-term data, as I show here, these strategies can offer significant returns. The key is to understand and embrace the volatility rather than fear it. By diversifying our portfolios to include a mix of both traditional and unconventional strategies, we can reduce risk while maximizing potential returns. It's all about finding the right balance, and I'll talk about that in another video. Just as the Oakland A's management didn't rely solely on traditional metrics, we shouldn't rely solely on traditional investment strategies like buy and hold, or on the other extreme, day trading for small profits. Let's also consider the importance of behavioral finance. Kahneman's work on cognitive biases highlights how our psychological tendencies can lead us astray. For example, the availability heuristic can cause us to overvalue recent information or dramatic events. This bias can lead to poor investment decisions like panic selling during a market downturn or chasing after the latest hot stock, which may be overvalued. Understanding these biases helps us make smarter decisions. By knowing that our instincts might not always be the best for investing, we can change our approach to be based on data and less on emotions. Just like the Oakland A's use statistics to find undervalued players, we can use systematic trading to find and take advantage of market opportunities. Systematic trading means using algorithms and models to make decisions based on numbers instead of gut feelings. This helps remove emotional bias and makes trading more consistent. By using data and technology, we can spot patterns and trends that might not be obvious with traditional analysis. This method doesn't replace human intuition, but adds strong data-driven insights to it. The story of Moneyball isn't just about baseball. It's about finding and using opportunities that others might overlook in any market. As investors, we should be open to strategies that might not seem appealing at first, but can improve our overall performance. By diversifying with both popular and less popular strategies, we can achieve better long-term results. Remember, just as the Oakland A has succeeded by looking beyond appearances, we can find investment success by looking beyond conventional wisdom. Embrace the data, understand the biases, and be open to unconventional strategies. The results might just surprise you. Thank you for joining me today. Please subscribe and join my Patreon channel for more in-depth analyses and thought-provoking content. Until next time, invest well.